Mark, is that where we're going, a new Cold War? And if so, what are the implications?
There's no question we're in a new Cold War, because what he said, this is a very, very strong speech on the part of President Biden. It's amazing that in addition to the economic assistance, he emphasized the military assistance. That means that there's going to be an escalation of this. And basically what we're looking at is this is going to be Russia's Afghanistan. They are going to tie Russia down in Ukraine for quite a long time. But what that also means, of course, is that Europe is very insecure. Of course, you've already seen the DAX and the French market crash. And I think you're going to see a lot of the assets in Europe not being in good shape. But the good news is that the other parts of the world are doing very well. Brazil is up. South Africa is up, obviously, because of commodities. And Asia more or less is flat, with the exception of China, which is down. But I think probably China is going to be a winner in this case.
What, you do not think that China at all will pay a price for being shoulder to shoulder with Russia at this point?
They will from a PR point of view, but they probably will pull back and become more neutral. But the reality is that trade with Russia will probably increase. It's going to be probably difficult for the West to convince China to stop trade with China. But that's an interesting possibility. If that happens, then Russia's really in big trouble.
And you have said before that China could be a sort of haven in this environment. Where else may there be opportunity, Mark, as we see obviously emerging markets flows being forced essentially out of Russia?
Of course, you know, the haven for safety is always the U.S. And you've seen the U.S. dollar really doing very well. The euro has crashed. It's almost in par with the U.S. dollar, which we never expected to see. So now it's really havens like U.S. market, gold. Look at Palladium. Palladium is up, what, 120% from the bottom. Of course, the reason is that Norilsk nickel in Russia is one of the biggest producers of palladium. So there's some of these commodities that are going to do very well. So, you know, they're going to be winners and losers, let's put it that way. And so we have to be very cautious in the way we look at this and pick the right places.
Mark, are we heading for a recession? You bring up Europe. Is there going to be a recession in the United States? Goldman Sachs today upgrading its forecast for the possibility of a recession in the United States. Is Europe heading for a recession? Is America heading for a recession?
Europe, I think, is probably headed for recession or, let's say, economic difficulty. I don't think the U.S. is. I think the U.S. is probably going to be ramping up production of military goods, for example. That will help the economy. But also, generally speaking, the interest rate rise is already factored in to the market. So I think that's not going to be a big problem for the U.S. And I think the U.S. will do fairly well in this environment.
Well, you mentioned interest rate hikes, Mark. Given the war in Ukraine, do you expect monetary policy to have to be more or less aggressive given the inflationary impulse and the fuel added to that fire?
Probably less aggressive. I think the Fed is going to be much more cautious in this kind of environment, which, of course, is happy news for people in the bond market. But they're definitely going to raise interest rates, but not as aggressively as they thought they would because of this situation.
Mark, let's just talk about how you position a portfolio right now. I heard what you just said about the bond market, but nevertheless, bonds have been going down. We've seen yields coming up. We've seen equities coming down. Commodities obviously have been a place that have been performing very well. But nevertheless, the kind of the main components of a balanced portfolio, let's call it a 60-40 portfolio, are not performing right now. If that continues, at some point, and David Wu was talking about this, at some point we're going to have to see risk parity funds and other funds being forced sellers. Is that point coming soon?
I think that's already happened in many cases. We've seen that in the case of China, for example. One of the reasons why the Chinese market has done so poorly is because there's so many people that are indexing the market, and of course they're forced to sell when the index goes down. Emerging markets index, for example, has been battered because of the heavy weighting of China. But people who have been stock picking, who have not followed the indexes, who are not in ETFs, have done fairly well because there are a lot of stocks out there that have done very good in this environment. Of course, companies that don't have debt, number one, and companies that have a good return on capital. So there are many opportunities out there still, and probably will be more as we go forward in this environment. It's going to be very interesting to see how that plays out.
Sticking with China, Mark, how large a concern is the regulatory crackdown for you? Just today, DiDi Global, which of course is the Chinese ride-hailing company listed in the U.S., intends to delist, wanted to relist in Hong Kong, now has to put that on hold because of the cybersecurity probe not necessarily going the way regulators want. It's down 38%. You're seeing tech at its lowest when it comes to the Hang Seng Tech Index since March of 2020. With that kind of regulatory overhang, how much of a headwind is that for Chinese markets?
Well, I first felt that the regulatory crackdown in China was probably good because it created a more level playing field. Now, of course, it's had not good consequences for the index, that's for sure, but mainly because of the impact on the big cap stocks. But at the end of the day, what's really pushing the market in China down is debt. There's an incredible amount of debt, not only in the property sector, but in other sectors. I don't know that you know, in the nickel market, for example, there's a big disaster. So I think that's really the worry about China, debt.
Mark, you've been really positive about China in the past. How significantly changed are your views now, say, versus even 3 months ago on what is happening in China?
We've been very light in China. We've been more concentrated in India because we thought there were more opportunities in India. But we have a little bit in China. But again, mainly stock picking, picking stocks that were not the big caps, the medium and small caps. And I think there's still opportunities there, but I think in view of this environment, we have to be very cautious. I necessarily, at this stage of the game, would not be adding.
Mark, you mentioned nickel there, which obviously blew up in quite dramatic fashion this week. I'm wondering what your view is of the metals at this point.
I think nickel prices will do quite well going forward. As you know, one of the biggest producers is Norilsk Nickel in Russia. Given the fact that you have these sanctions, it'll be difficult for people to get their hands on nickel. So nickel should do fairly well. And of course, you've seen the counterpart that, you get palladium with nickel. Palladium has gone through the roof. It's done better than gold, far better than gold, in fact. So I think nickel will be okay.
Final question from me, Mark. What do you think about cash right now? In this kind of environment, do you need to be invested?
Cash is king in an environment like this. But I would not put more than 15% in cash at this stage of the game. Now's the time to be stock picking and looking at good stocks that have gone down a lot for no good reason, just because of the environment or because of the index. And now I would say equities is the key, not fixed income, but equities is where you want to be.